All right, let's dive in. Today, we're tackling the world of intelligent investing
Oh, yeah.
using the ultimate guide,
Okay.
Benjamin Graham's The Intelligent Investor.
Classic.
Now we've got Jason Zweig's commentary alongside it to bring it into the modern day.
Right.
So we're going to unpack Graham's core principles and see if they still hold up in today's...
Yeah. Today's crazy market.
It's a wild one out there.
It is. It's fascinating how relevant Graham's insights remain
Yeah,
even decades later.
absolutely.
We'll be exploring everything from market psychology and how to avoid those emotional pitfalls
Like,
to identifying undervalued companies and building a resilient portfolio that can weather any storm.
oh, and just to give you a little taste of what's in store.
Okay.
We'll uncover how even a genius like Sir Isaac Newton lost a fortune in the stock market,
Oh, wow.
proving that even brilliant minds can fall prey to market mania.
You know, they say
It's true.
everyone is a genius in a bull market.
That's right.
You know what I mean?
Makes you feel real smart. All right, we'll also explore this intriguing world of net nets,
Oh, yeah.
where you can potentially snag a company's stock for less than the cash they have in the bank.
Less than the cash. That's wild.
Talk about a steal.
Yeah.
But before we get ahead of ourselves,
Right.
let's start with the foundation. What exactly is intelligent investing according to Benjamin Graham?
Yeah, what is it?
Hit me with Graham's definition.
Okay, well, right from the get-go, Graham throws down a gauntlet, challenging us to rethink
Mm-hmm.
our approach to investing.
Okay.
He defines intelligent investing as, and I quote,
Yeah?
an operation promising safety of principal and an adequate return after thorough analysis.
Okay.
It's not about gambling on hunches or chasing those get-rich-quick schemes.
So it's more about being a detective than a gambler,
Yeah,
carefully examining the evidence before making a move.
yeah.
I like that. What are the key elements that really stand out in this definition?
3 things jump out at me.
Okay.
Thorough analysis, protection against serious loss, and reasonable return expectations.
Reasonable, all right.
Notice he's not promising to turn you into a millionaire overnight.
Right.
He's advocating for a methodical,
Mhm.
almost scientific approach to investing.
He really wants you to think like a business owner,
Exactly.
carefully assessing the value of the businesses you're buying into,
Yeah,
not just some random stock ticker.
precisely. And this is where Graham draws a sharp distinction between intelligent investing and speculation.
Right.
The speculator is like a gambler at a casino,
Okay.
betting on short-term price movements, hoping to get lucky.
I've been there.
The intelligent investor, on the other hand,
Yeah.
is like a detective, carefully examining the evidence,
Mhm.
looking for those undervalued opportunities that the market has overlooked.
It's all about separating the signal from the noise,
Yeah.
cutting through those emotional swings and hype cycles that can cloud our judgment.
And speaking of emotional swings, Graham introduces us to a rather colorful character
Oh.
he calls Mr. Market.
Mr. Market, fill me in. Who is this guy?
Picture this. A manic, depressive business partner who shows up at your door every day,
Right.
offering to buy or sell your shares at wildly fluctuating prices.
No.
Some days he's euphoric, convinced the market is going to the moon, and
Mhm.
other days he's in the dumps,
Right.
convinced the world is ending.
Sounds exhausting.
It can be.
So how do we deal with this unpredictable character?
That's the key understanding that Mr. Market is driven by emotions,
Okay.
not logic.
Not logic, got it.
His mood swings can create incredible opportunities for intelligent investors.
So we can actually use his craziness to our advantage.
Exactly. Imagine Mr. Market offering to sell you shares of Amazon
Okay.
at a fire sale price
Yeah.
because everyone's panicking about a temporary dip in their earnings.
I can see it now.
Would you have the guts to buy, knowing that the underlying business is still incredibly strong?
Interesting question.
That's the kind of opportunity intelligent investors look for.
It's about having the discipline to think for ourselves, to do our own research, and not get swept up in the crowd's fear or greed,
Right.
you know?
Zweig's commentary had some really insightful modern-day examples
Okay.
of Mr. Market's shenanigans.
Oh.
Like the dot-com bubble of the late 1990s,
Oh, yeah.
when even seasoned investors got caught up in the hype,
Mhm.
driving prices of internet companies to ludicrous levels.
That's a case of irrational exuberance.
Exactly.
And when the bubble burst, well,
Yeah,
let's just say a lot of people learned the hard way
okay.
that Mr. Market can be a cruel mistress
For sure.
if you don't understand his game.
Yeah.
So how do we, as intelligent investors, learn to play the game better? What strategies does Graham offer
Whoa.
to keep us from losing our shirts?
Graham lays out two main approaches for intelligent investors.
Okay.
The defensive strategy and the enterprising strategy.
All right.
Let's start with the defensive approach, which is perfect
Okay.
for those who want a more hands-off approach.
Oh, right.
A set it and forget it kind of strategy.
That sounds right up my alley. Low maintenance is my middle name.
Well, then you'll appreciate this.
Okay.
The defensive investor, as
Yeah.
Graham describes them,
Mm-hmm.
prioritizes safety and freedom from constant stock watching.
Got it.
They're not looking to spend hours poring over financial statements
Right.
or trying to time the market.
So what does a defensive portfolio actually look like? What kind of investments are we talking about here?
Graham generally recommends a portfolio split equally between stocks and bonds.
Okay.
This provides a balance of growth potential from stocks
Mm-hmm.
and stability from bonds.
Okay.
He also highlights the potential benefits of tax-free bonds,
Oh, yeah.
especially for those in higher tax brackets.
Yes, those lovely tax breaks.
Yeah.
Who doesn't like those?
Yeah.
But what about those inevitable market fluctuations?
Yeah.
How do we navigate those choppy waters without getting seasick?
Graham recommends a technique called dollar cost averaging,
Okay.
which is brilliant in its simplicity.
Right.
Instead of trying to time the market perfectly, which, let's face it, is virtually impossible.
Pretty much, yeah.
You invest a fixed amount of money at regular intervals,
Okay.
regardless of the market's ups and downs.
So if the market dips,
Yeah.
you're buying more shares at a lower price.
Mm-hmm.
And if the market climbs,
Yep.
you're buying fewer shares at a higher price.
Right.
It's a way to average out your cost over time.
Exactly. And here's where Zweig comes in with a fantastic modern-day twist
Right.
on this classic strategy.
Okay.
He suggests that index funds,
Yes.
which passively track a specific market index like the S&P 500,
Mhm.
have become a super simple and effective way for defensive investors
Yeah.
to gain broad market exposure with very low fees.
That's like an autopilot for your portfolio.
Yeah,
Steadily accumulating wealth over the long term.
precisely.
Now, what about those of us who are a bit more hands-on?
Okay.
Who enjoy digging into the details and maybe even picking individual stocks?
Yeah,
That's where Graham's enterprising investor approach comes in.
right.
Now, this is where it gets really interesting.
I know.
Tell me more about this enterprising approach.
The enterprising investor is willing to put in more time and effort,
Okay.
carefully researching and selecting individual stocks that they believe are undervalued by the market.
So it's still about finding those bargains,
Yes,
but with a more active and engaged approach.
exactly.
Sort of like those treasure hunters who spend hours sifting through sand,
Right.
looking for that one rare, valuable gem.
Exactly.
And Graham provides some specific criteria for identifying these potential gems.
No, yeah.
One of his classic strategies is to focus on stocks selling below their net working capital.
Okay.
Now, hold on. Before we dive into that,
Right.
can you quickly explain what net working capital means
Sure.
for those of us who haven't been living and breathing finance?
Of course. It's actually quite straightforward.
Okay, good.
Net working capital is basically the difference between a company's current assets,
Okay.
things like cash,
Mhm.
inventory,
Right.
and accounts receivable,
Okay.
and its current liabilities,
Right.
things like accounts payable and short-term debt.
So it's a measure of a company's short-term financial health?
Exactly.
Basically, how much cash they have on hand to cover their immediate obligations.
Exactly. And Graham believed that if you can find a company whose stock is trading
Mhm.
for less than its net working capital,
Less than its net working capital.
they're essentially buying $1 for 50 cents.
You're getting all of the company's long-term assets, its factories, its brand,
Yeah.
its intellectual property, essentially, for free. That's wild.
I know.
Are you telling me these opportunities actually exist out there?
They do. Graham's research showed that these net situations, as they're sometimes called,
Okay.
have historically provided excellent returns for patient investors.
This is blowing my mind. So where do we find these hidden gems? Are we talking about digging through?
It does require some digging,
Yeah.
but thankfully today we have access to more financial data than ever before.
That's true.
Zweig suggests that with online databases and screening tools,
Yeah.
these opportunities might be found in smaller, less followed companies
Mm-hmm.
that haven't yet caught the attention of the big institutional investors.
Just like an online treasure hunt for undervalued businesses.
Yeah.
Count me in.
Yeah.
But even for us enterprising investors,
Right.
I imagine Graham still emphasizes caution and thorough analysis, right?
Oh, absolutely.
We're not just throwing darts at a dartboard hoping to hit a bullseye.
You got it. Graham always stresses the importance of thorough analysis
Okay.
and maintaining a margin of safety even when we think we found a screaming bargain.
And Zwei's commentary really drives this point home
Yeah,
with some sobering examples of what can happen
right.
when investors get caught up in the hype
Yeah.
chasing after IPOs.
Those initial public offerings.
Yes, those initial public
Or
offerings
companies go public for the first time, selling their stock to the public.
and so-called hot stocks without doing their due diligence.
Right.
He reminds us that IPOs are often priced with a lot of hype and optimism baked in,
Yeah,
making it tricky to assess their real worth.
that's right.
It's like trying to figure out how much to pay for a used car
Right.
based solely on the salesperson's glowing description
Yeah.
without even looking under the hood.
That's a great analogy.
And speaking of timeless wisdom,
Okay.
Graham had some strong opinions about dividends.
Oh, yeah.
Those lovely little payments that companies can make to shareholders.
Ah, yes, dividends.
I love them.
Graham saw them as a tangible sign of a company's financial health
Yeah.
and a signal that the management team is shareholder-friendly.
Okay.
He wasn't a fan of companies that hoarded cash instead of sharing the wealth with their investors.
It's like getting a little thank you note from the company.
Yeah.
Little bonus for being a part owner of the business.
Precisely.
But as Zweig points out,
Uh-huh.
there's been a shift in corporate behavior since Graham's time.
Okay.
Stock buybacks,
Yeah.
where companies use their cash to repurchase their own shares,
Right.
have become more common than dividends.
More common than dividends. Wait, hold on.
Yeah.
If a company has all this cash,
Yeah.
why wouldn't they want to pay dividends? What's the catch with these buybacks?
Well, while buybacks can potentially boost earnings per share,
Okay.
Zweig raises concerns that they're often used to benefit executives,
Okay.
particularly those with stock options,
Right.
more than long-term shareholders.
Okay, I see where this is going. Break this down for me.
Think about stock options.
Yeah.
When a company buys back shares,
Right.
the stock price often goes up,
Mm-hmm.
making those options more valuable.
Right.
It's like a hidden bonus for the executives,
Right.
often at the expense of those who are holding the stock for the long haul.
It's a fascinating insight into how corporate priorities have evolved,
Yeah.
and a reminder that we need to be savvy investors,
Yes.
critically evaluating a company's actions and understanding their potential impact.
On our investment returns.
Now, to really solidify these concepts,
Okay.
Graham takes us even deeper,
Right.
providing some captivating case studies in his book.
I love this part. It's like getting a front row seat to the world of investing.
I know, right?
Seeing these principles play out in real-life scenarios,
It's great.
what kind of case studies does he explore?
He presents 4 extreme cases,
Okay.
both successes
Yeah.
and spectacular failures,
Oh, wow.
to illustrate the power of intelligent investing
Okay.
and the perils of ignoring its principles.
And the perils.
One of the most shocking examples is
Right.
the bankruptcy of the Penn Central Railroad,
Oh, wow.
a company that had been paying dividends for over a century.
For over a century.
It's a stark reminder that even seemingly stable companies
Yeah.
can face unexpected challenges.
It's a classic example of why we can't just rely on past performance
Right.
as an indicator of future success.
Yeah.
We need to dig deeper to understand the underlying fundamentals of the business and the risks involved.
Absolutely. Another cautionary tale Graham explores
Okay.
is the story of AAA Enterprises,
Right.
a small company built on a foundation of franchising that turned out to be anything but solid.
Oh, wow.
It highlights the importance of carefully scrutinizing a company's business model,
Yeah.
especially when it relies heavily on rapid expansion and franchising fees.
It sounds like these case studies provide invaluable lessons for investors,
They do.
reminding us to be skeptical, to do our homework,
Yeah.
and to always be aware of the potential for things to go wrong,
Yes.
even with seemingly promising investments.
Precisely.
And these are just a few of the fascinating case studies
Right.
Graham explores in the book,
Yeah.
but we're just scratching the surface here.
I know, right?
In the next part of our deep dive,
Okay.
we'll explore how intelligent investors can navigate those inevitable market fluctuations,
Right.
debunk some common investment myths, and discover the true meaning of risk, not just in the companies themselves,
Yeah.
but in our own behavior and emotional reactions.
Now that's a cliffhanger.
I'm already hooked. Let's get to part 2.
Okay.
Welcome back to our deep dive into the intelligent investor. We're picking up where we left off, exploring Graham's insights on how to navigate the often turbulent waters of the stock market.
You know, one of the things that makes Graham's work so timeless
Yeah.
is his focus on the psychological aspects of investing.
Mhm.
He understood that our emotions can be our worst enemy when it comes to making sound investment decisions.
It's so true. I remember when I first started investing,
Oh, yeah.
I'd get totally freaked out whenever the market took a dip.
Oh, yeah.
I'd be tempted to sell everything and hide my money under the mattress.
I think we've all been there.
I think so.
But Graham reminds us that the market is inherently unpredictable in the short term.
Right.
It's driven by those emotional swings we talked about earlier, Mr. Market's manic depressive tendencies.
So how do we avoid getting swept up in those emotional currents?
Yeah, it's tough.
How do we stay calm and rational when everyone else is losing their heads?
Well, Graham encourages us to remember that for the intelligent investor, a stock is not just a ticker symbol flashing on a screen.
Right.
It represents ownership in a real business. We need to focus on the underlying fundamentals of the business, not the daily noise of the market.
It's like remembering that a ship might be tossed around by the waves, but as long as it's seaworthy,
Right.
it will eventually reach its destination.
Exactly. And Graham teaches us to view market declines not as threats,
Okay.
but as potential opportunities.
Okay.
If a solid business we've researched experiences a temporary drop in its stock price due to market sentiment, that could be a chance to buy more shares at a bargain.
Ah, yes. The classic buy low, sell high principle.
Yeah,
But it's so much easier said than done.
I know.
It takes real discipline to go against the herd mentality
Yeah.
and buy when everyone else is selling.
And that's where Zweig's commentary adds another layer of insight. He reminds us that the real risk for investors often lies not in the companies themselves, but in our own behavior.
It's like that saying, we have met the enemy and he is us.
It really is.
Our own fear and greed can lead us to make irrational decisions, like panic selling at the bottom of the market, or chasing after the latest hot stock without doing our homework.
Exactly. And that's why Graham stresses the importance of having a sound investment philosophy, one based on principles
Yeah.
and not driven by those emotional impulses.
So we're not just investing in companies.
Yeah.
We're investing in our own ability to stay calm and rational.
Yes.
When Mr. Market starts throwing his tantrums,
Right.
we need to develop that mental fortitude to stick to our plan
Yeah.
and not get rattled by the market's inevitable ups and downs.
You got it. And one of the key principles that can help us stay grounded is the concept of margin of safety,
Okay.
which Graham considered the most important principle for the intelligent investor.
Margin of safety, that sounds intriguing. Tell me more.
Okay, it's basically the difference between the price you pay for an investment and its intrinsic value.
Okay.
If we can buy a stock for significantly less than what we believe it's truly worth,
Yeah.
that difference acts as a buffer, protecting us from losses if our assessment turns out to be a bit off.
So it's like having a built-in cushion for those inevitable bumps in the road.
Yeah.
It's about acknowledging that we can't predict the future with perfect accuracy.
Right.
So we need to build in some room for error.
Exactly. But here's the thing.
Yeah.
The margin of safety isn't some magical number you can pull out of thin air.
Okay.
It requires careful analysis and a realistic assessment of the business's prospects.
That's where those deep dives into a company's financials and understanding its true earning power
Yeah.
becomes so valuable. We need to be able to separate the hype from the reality.
Yeah.
To cut through the noise and understand what a business is truly worth.
Right. And Zweig highlights how the margin of safety has become even more critical in today's market, where valuations can be driven by hype and short-term speculation.
Yeah, with the rise of social media and the 24/7 news cycle, it seems like information and misinformation spreads faster than ever before.
It really does.
It's even easier to get caught up in the hype and lose sight of those fundamental principles.
Absolutely. And that's why Zweig reminds us that the margin of safety isn't just about protecting us from losses.
Okay.
It can also enhance our returns. If we buy a great business at a bargain price,
Yeah.
the potential upside is even greater.
Okay.
It's like getting a double dose of investing goodness.
So it's a win-win, protecting our downside
Yeah.
while also maximizing our potential gains. But how do we actually go about finding these bargain opportunities?
Yeah, that's the question.
Was Graham offer any specific strategies?
He does. One of his classic approaches is to focus on those stocks selling below their net working capital, which we discussed earlier.
Right, those net-net situations where we're essentially buying a dollar for 50 cents.
Yes.
It's such a powerful concept, but it almost seems too good to be true. Are these opportunities really out there in today's market?
Well, Graham's research showed that they've historically provided excellent returns.
Okay.
And Zweig suggests that with access to more financial data than ever before,
Yeah.
these opportunities might be found in smaller, less followed companies
Right.
that haven't yet caught the attention of those big institutional investors.
So it's not just about crunching numbers. It's also about being curious
Yeah,
and exploring those less traveled corners of the market.
I
It's like
saw.
being an investment archaeologist, unearthing those hidden treasures that everyone else has overlooked.
Exactly.
Yeah.
Now, Graham also provides guidance on selecting stocks with a more qualitative approach,
Okay.
looking beyond the numbers to assess the quality of the business and its management team.
Let's dive into that. What qualities should we be looking for?
He emphasizes the importance of finding companies with a long and consistent track record
Oh,
of earnings and dividends. It's about identifying those businesses that have proven themselves over time,
yeah.
not just the latest flash in the pan.
So it's not just about growth. It's about sustainable, profitable growth.
Right?
It's like looking for a tree with deep roots,
Yeah,
not a flimsy weed that might wither away in the first strong wind.
that's a great analogy. And he also suggests that investors pay attention to a company's financial strength,
Okay.
ensuring it has a solid balance sheet and can weather economic storms.
So it's like making sure the ship we're sailing on can withstand a hurricane,
Right.
not just a gentle breeze.
Yeah.
We want to be confident that the companies we invest in
Mm-hmm.
can handle those inevitable challenges that arise in the business world.
And here again, Zweig brings a modern perspective to Graham's timeless advice.
Okay.
He suggests that in today's fast-paced business environment, it's also crucial to consider a company's ability to adapt and innovate,
Right.
to stay ahead of the curve in a world that's constantly evolving.
So we're looking for companies that are not only financially sound,
Right.
but also have that entrepreneurial spirit, that ability to anticipate and respond to change.
Exactly. Now, while growth is important, Graham cautions investors
Okay.
against getting caught up in the allure of so-called growth stocks,
Okay.
particularly those with sky-high price-to-earnings ratios,
PE ratios.
or PE ratios for short.
I've heard about PE ratios.
Yeah.
It's basically a measure of how much investors are willing to pay
Right.
for each dollar of a company's earnings.
Right.
So a high PE ratio suggests that investors are very optimistic
Yeah.
about a company's future growth prospects.
And while some growth stocks can undoubtedly be great investments,
Yeah.
Graham warns that they often carry a high degree of risk. Their
Right.
valuations are heavily reliant on future expectations,
Hmm.
which can be notoriously difficult to predict.
It's like betting on a horse race. You might think you've picked the winner,
Exactly.
but there are so many variables that can impact the outcome.
Right.
A lot can change between now and the finish line.
And Zweig offers some compelling examples of how high-flying growth stocks can come crashing down to earth when those lofty expectations aren't met.
Right.
He reminds us that even for the most promising growth companies,
Yeah.
it's crucial to maintain that margin of safety
Right.
and not overpay for that potential.
So it's about balancing that excitement for growth with a healthy dose of skepticism
Yeah.
and a focus on value. We need to make sure we're not paying an exorbitant price for that growth potential.
Now, along with evaluating individual companies, Graham also delves into specific industries and types of investments that investors should approach with caution.
Okay, I'm all ears. Fill me in on the red flags we should be watching out for.
He's particularly wary of industries that are highly competitive
Okay.
and prone to rapid change, where even well-managed companies can struggle to maintain their profitability.
Right.
Think about the technology sector, for example, where innovation moves at breakneck speed, and today's market leader can quickly become tomorrow's also-ran.
It's a reminder that we need to be aware of those industry dynamics
Yeah.
and how they might impact the long-term prospects of the companies we're considering investing in.
Right.
We can't just look at a company in isolation.
Right.
We need to understand the broader landscape in which it operates.
Exactly. And he's also skeptical of new issues. Those companies going public for the first time through those IPOs we talked about earlier.
He's basically saying we need to be cautious about jumping on the IPO bandwagon, right?
Sure.
Why is that?
He points out that IPOs are often priced with a lot of hype and optimism baked in, making it difficult for investors to accurately assess their true value.
Right.
It's like trying to catch a falling knife. It might look exciting, but it's probably going to end badly.
Ouch. I'll try to remember that image the next time I'm tempted to invest in a hot new IPO.
Good idea.
Now, another phenomenon that has fascinated and often terrified investors throughout history is the market bubble. Does Graham offer any insights on how to avoid getting caught up in those periods of irrational exuberance?
He does. Graham observed that market bubbles often occur when speculation and emotion run rampant,
Right.
driving prices far beyond any reasonable measure of intrinsic value.
Yeah.
It's like that collective frenzy we talked about earlier,
Yeah.
where everyone is convinced that the market can only go up
Yeah.
and no price is too high to pay for a piece of the action.
It's almost like a mass hallucination where
Sure.
people lose touch with reality and get swept up in the euphoria of the moment.
Exactly. And he warns that these periods of irrational exuberance
Yeah.
are often followed by painful crashes, leaving investors who bought in at inflated prices with heavy losses.
Ugh.
It's a stark reminder that history often repeats itself,
Yeah.
and that as intelligent investors, we need to be aware of these patterns and avoid getting swept up in the euphoria.
So how do we protect ourselves from those potentially dangerous situations? How do we recognize the warning signs of a bubble
Yeah, how do we do it?
and avoid getting sucked into the vortex?
Graham emphasizes the importance of sticking to our principles,
Are you?
focusing on intrinsic value, and maintaining that all-important margin of safety.
Right.
We can't control what the market does, but we can control our own decisions
Right.
and avoid getting swept up in the speculation.
It's about having that inner compass that guides us towards sound investment decisions, even when the world around us seems to have gone mad.
Exactly. And Zweig adds a really helpful suggestion.
Okay.
He advises investors to have a written investment plan
Okay.
outlining their goals, risk tolerance, and investment strategy.
Having that plan in place, something we can refer back to when things get crazy,
Right.
can help us stay grounded and make rational decisions even when Mr. Market is trying to tempt us into doing something foolish.
Yeah.
It's like having a set of rules for navigating a treacherous jungle.
It's a fantastic way to avoid those emotional pitfalls and stay focused on our long-term investing objectives.
Absolutely.
Now, in the next part of our deep dive, we'll explore some of Graham's less discussed but equally important insights on investor management relations, dividend policy, and the crucial role of shareholder activism.
This sounds like we're going to be getting into some juicy topics.
Oh, yeah.
It's not just about picking stocks, it's about understanding our rights and responsibilities as shareholders. I can't wait to dive in.
Let's do it.
All right, welcome back to the deep dive. We're wrapping up our exploration of the intelligent investor.
Okay.
And I'm feeling like I've leveled up my investing knowledge for sure.
Yep.
In this final part, we're digging into a topic that's super relevant in today's corporate world.
Yeah.
Investor management relations, dividend policy, and the power of shareholder activism.
You know, it's fascinating how Graham's insights on these topics are just as relevant today as they were decades ago.
Yeah.
He really emphasized that shareholders should be active owners,
Okay.
not just passive bystanders.
So we're not just voting with our wallets when we buy a stock. We actually have a voice in how the company is run.
Absolutely. Graham believed that shareholders have a right and a responsibility to hold management accountable for their decisions and advocate for policies that align with their interests as investors.
That's almost like we're part of a team,
Yeah.
working together to steer the company towards success. But how do we actually put this into practice? I'm not exactly strolling into the boardroom anytime soon.
Well, Graham lays out several avenues for shareholder activism.
Yeah.
We can vote against directors who aren't performing well, attend annual meetings, and voice our concerns.
Okay.
And even join forces with other shareholders to put pressure on management to make changes.
It's empowering to know that we have options,
Yeah.
that we're not just powerless pawns in this corporate game.
And Zweig points out how shareholder activism has evolved since Graham's time.
Right?
With the rise of institutional investors and activist hedge funds,
Right.
shareholders have even more power to influence corporate behavior.
So it's not just those lone wolf investors fighting for change anymore. There's strength in numbers.
Exactly. Now, let's shift gears a bit and talk about dividend policy, a topic that was near and dear to Graham's heart. He was a big believer in dividends
Yeah.
as a tangible sign of a company's financial health
Okay.
and a signal that management is committed to sharing profits with its owners.
Dividends are like those little bonus checks that show up in our mailboxes,
Right.
a reward for being patient, long-term investors.
You got it. And Graham believed that companies should prioritize paying dividends over stock buybacks,
Okay.
especially when their shares are overpriced. He saw buybacks as potentially manipulative,
Right.
especially when used to inflate earnings per share or boost executive compensation.
That makes sense. Buybacks can benefit those with stock options, but what about us regular shareholders? Are we getting a fair shake?
That's the question Graham wants us to ask.
Okay.
Zweig adds that while buybacks can sometimes be beneficial,
Yeah.
they often come at the expense of long-term shareholder value.
Yeah. It's a reminder that we need to be critical thinkers
Yeah.
and not just blindly accept corporate actions at face value.
Right.
We need to understand the motivations behind them and how they might impact us as shareholders.
Couldn't have said it better myself. As we wrap up our deep dive,
Yeah.
it's clear that The Intelligent Investor offers timeless principles that are as relevant today as they were when Graham first wrote the book.
It's been a fascinating journey, and I feel like I've gained some valuable tools and insights to become a more intelligent investor.
Remember, intelligent investing is about more than just picking stocks. It's about developing a sound investment philosophy,
Okay.
conducting thorough research,
Right.
staying disciplined in the face of market fluctuations,
Mm-hmm.
and always maintaining that crucial margin of safety.
It's about thinking like a business owner, not a gambler,
Right.
and understanding that true investment risk often lies not in the companies themselves,
Yeah.
but in our own behavior and emotional reactions.
So as we navigate the complexities of the modern financial landscape, let's keep Graham's wisdom close at hand, guiding us towards those intelligent investment decisions that can help us achieve our financial goals.
Well, that just about wraps it up for our deep dive into The Intelligent Investor.
It's been a pleasure
It really has.
talking about this stuff.
Fascinating.
Thanks for listening, everyone.
And remember, the journey of intelligent investing is a lifelong pursuit.
Yeah, it is.
Keep learning, keep growing,
Yeah,
and most importantly, keep diving deep.
absolutely.